All right, let's talk. You're a go-getter. You built your business from the ground up, pouring in sweat, long hours, maybe a little coffee-fueled magic. You're your own boss, charting your own course, and that is something to be proud of. But then comes the day you decide to buy a home. Suddenly that same independence feels like a roadblock. The bank asks for W-2s, and you chuckle. A W-2? You haven't seen one of those in years. So what's the secret sauce for the self-employed? For many, it's a game changer called the bank statement loan. Think of it as a mortgage that speaks your language. Instead of asking for tax returns that show a minimized income for tax purposes, this loan looks at the real money flowing into your bank accounts. It's designed for when tax documents don't paint your full financial strength. This is your W-2 alternative. The key when the traditional path is blocked. It's simple. Prove income with your bank statements. It shows what you actually earn, month in and month out. Lenders who offer these programs are essentially saying, "Show us the cash." They get that smart business owners legally reduce taxable income. That's just smart business. So they bypass the tax returns and instead ask for 12 months of your bank statements, 24 months of your bank statements. Why the range? A 24-month look-back gives a more stable, long-term view, which can often lead to better rates and terms. 12 months is fantastic for newer or fast-growing businesses. It lets you qualify on your recent success, not 2 years ago. This flexibility is what makes it so powerful. You can use business statements or personal statements. If you use your business account, when a mortgage underwriter gets your stack of 12 or 24 bank statements, they aren't just glancing at the final balance. They are playing detective, piecing together the story of your business's financial health. Their mission is to verify consistent, predictable income flow. They're listening for the rhythm of your revenue. Are deposits regular weekly, monthly, or are they sporadic and unpredictable? Steady deposits are like gold to an underwriter. Stability signals you can support a monthly mortgage payment. They want to see deposits from business operations, clients, Stripe, PayPal, clear revenue sources. One-time transfers or gifts won't count toward qualifying income. Clean, organized records help them connect the dots and see legitimate, recurring income. Even with bank statement loans, some self-employed still use traditional tax returns because it can be great if you show strong net income. Underwriters look past gross revenue and focus on adjusted gross income after deductions. They want strong, stable, or rising income over 2 years. Deep dives into Schedule C, S-Corp, or LLC returns. Consistency is king. $150,000 one year, $40,000 next year? Red flag. They'll want a solid explanation. Often, they average the last 2 years for qualifying income. Savvy underwriters add back non-cash or one-time items. Depreciation, mileage, certain interest. These can improve your numbers. Many miss this. An expert makes sure it isn't overlooked. With expertise, they see your true story, not just the numbers. Now let's talk to real estate investors. You've found the perfect rental property. The numbers work. The location is prime. It's poised to be a fantastic cash-flowing asset. But then they ask for your personal tax returns, W-2s. Your full-time income is tied up in properties, or your day job doesn't qualify you for another mortgage. This is where the DSCR loan comes in. It qualifies you on the property's income, not your personal income. DSCR stands for Debt Service Coverage Ratio. It measures if rent covers the mortgage. Formula: gross rental income divided by total housing expense. Principal, interest, taxes, insurance. A 1.0 ratio means rent exactly covers payment. Most lenders want 1.25 or higher. That's a 25% cushion. $4,000 rent, $3,000 pity, DSCR 1.33. Qualified. No personal pay stubs, W-2s, or tax returns needed. Scale your portfolio without personal DTI limits. Great for single-family, small multifamily, even vacation rentals. Find cash flow with margin? DSCR can finance it. Treat each asset like a business. Performance first. The biggest hurdle isn't paperwork. It's misinformation. Myth: You can't get a mortgage without 2 years of W-2s. Absolutely false. Bank statement loans exist for exactly this reason. These lenders know your income isn't from a traditional employer. They've created a clear path to home ownership for you. Myth: you need perfect credit. Strong credit helps rates, but it doesn't have to be flawless. Many non-traditional programs, bank statement and DSCR, have flexible credit. Lenders often work with mid-600s if other factors are strong. Myth: lots of write-offs disqualify you. On traditional loans, big write-offs can hurt. But with bank statement loans, deductions are irrelevant. They aren't even looking at them. Myth: you need a huge 20 or 30% down. Not always. Some bank statement programs allow as low as 10%. DSCR loans for rentals are typically 20 to 25%. Exact amounts depend on credit, reserves, and the program. The idea that you must drain your life savings is just another myth. Knowing what to do is important, but knowing what not to do can be even more valuable. Biggest mistake: mixing business and personal finances. Running everything through one personal account creates an underwriting nightmare. They must separate groceries from client payments, vacations from business expenses. It muddies the water and hides true income. It can lead to delays or denial. Another error: inconsistent or declining deposits. Wild ups and downs make lenders nervous. A recent sharp decline can be a deal breaker. They may assume the business is failing. Manage invoicing and cash flow to show consistency, especially in the 6 to 12 months before you apply. Avoid long unpaid breaks or unexplained gaps. Next, incomplete documentation. Lenders need all pages of every statement, even the blank ones. It's picky, but required. Gather clean PDFs before you start. Bank statements, formation docs, P&L, and anything your loan officer requests. Avoid large, unusual deposits or new debt mid-process. Big cash deposits must be sourced, more paperwork. New loans increase your DTI. Once you start, keep your financial picture frozen. Now, practical steps to get mortgage ready. Separate accounts, organize statements, boost savings. Open a dedicated business checking and run all business income and expenses through it. Pay yourself a consistent monthly salary. Save clean PDFs monthly and keep your books current with a simple P&L. Aim for at least 6 months reserves. Lenders love it, you'll sleep better. And talk to a lender who specializes in self-employed borrowers. You've built your dream business through hard work and determination. Buying your dream home should be a celebration, not another struggle. Partner with someone who understands discipline and funds loans other lenders fear. Meet Kris McCullough and the KDM Team, specialists in bank statement, DSCR, and self-employed friendly loans. Reach out today. Find us on Facebook, YouTube, Instagram, or visit krismccullough.com. Your dream home is waiting. Go get it.